Alrighty guys, thank you for having us. Very excited to be here and have this discussion with you guys. We know you have a couple offers on the table. We're really excited to discuss kind of our recommendations to your committee. Larry's Laminate, great company. You guys have a lot in store for you, and we're looking forward to possibly getting you across that finish line in a transaction here. So moving on to introductions, I'll have Connor start.
Yeah, appreciate it. So I'm Connor O'Brien. I'm the Global Head of Industrials here. I've been industry experience about 22 years. Been at Star Capital for 7 years, and next is Nick.
Yeah, my name is Nick Marikoki. I'm the Global Head of Mergers and Acquisitions here at Star Capital. I have about 20 years of experience and 8 years here at Star Capital.
Hi everyone, my name is Sophia Markham. I am the Director of Diversified Industrials here at Star Capital. I have about 15 years of experience in the industry, and 5 of those years have been here at Star Capital.
Hey, good morning everyone. I'm Marcelo Shockey. I am the current VP of Mergers and Acquisitions here at Star Capital. I have 11 years of experience within the industry and 3 years here with our team.
We'll pass it over to Connor for a little bit about our background.
Yeah, this is an open dialogue, so anytime you have any questions, just feel free to butt in as well. But a little background about us is we were founded in 2005 by Gary Miller and RJ Niemer. Since inception, we've been a leading middle market investment bank. We have 3 arms. We have our staple M&A advising that is paired with capital raising, and recently just opened a consulting team. We have 300 plus employees. We've done about over 300 deals and have done about 40 similar deals, in this manufacturing hardware space.
So while we're on the background of Star Capital, I know in the email brief it was mentioned that you guys are aware of the success we had with one of your competitors down in Florida. This is one of our specialties. I just wanted to point out some other relevant transactions we've had as a sell-side advising firm. So for example, back in February 2021, we were the sell-side advisor for Airtime, who was acquired by Lennox. September 2021, we were the sell-side M&A advisor for Akron Coatings and Adhesive, and they were acquired by Hartville Hardware. We've also worked with private equity companies, so we were the sell-side M&A advisor for United Resin right before the start of the new year, and they were acquired by Platinum Equity. So we hope to kick off the new year working with you guys.
All right, thanks Sophie. So I'll be leading you all through a brief market overview, and really just want to highlight a few points before we then head into valuation. So overall, the laminated products industry is expected to grow at a rate of 1.1% year over year, leading into 2027. And compared to historical figures that we came up with, this is actually quite low. And with this, even though the industry is growing at a low rate, what we do think is this then leads to low risk of new entrants within the space. And so two main points we also want to hit on too is an increased demand from downstream customers will then, from the commercial markets and residential markets, will then lead to growth of revenues and will help Larry's Laminate come from their downturn from 2020 to 2021. And another thing too is to note is petrochemical costs are expected to drop leading into 2027 by 5.3%. And with this, it gives Larry's Laminate and also more specifically management the optionality to either continue charging a premium to customers or also to compete based on price with maybe future competitors.
So moving on into the bulk of our presentation, which is going to be your valuation for Larry's Laminate. Looking at our valuation football field here, we used 3 different methods: the discounted cash flow, trading comparables, and transaction comparables. We also have an LBO included here at the end to signify returns. Looking at our valuation, we had an average of around $111 million as our final enterprise value. We would see probably a little bit lower end on that spectrum just due to the comparables that we see and the numbers specifically weighted in the discounted cash flow statement. Looking at our discounted cash flow, we came up to a total enterprise value of $88 million to $109 million. Using the assumptions that we made below, this is right around what the private equity firm was offering for the company, with a 7 to 8 times multiple on an $11.6 million valuation as far as EBITDA goes. We are going to weight this discounted cash flow at about 50% when looking at the total enterprise value for the company. This is just due to us having predictable cash flows and being able to evaluate, the well-running business. We use a weighted average cost of capital of about 11.5%. This was stated in the case as what management could actually raise as debt, so we use that cost of capital. A couple things that we wanted to point to, such as our growth metrics, or I should say in terms of our growth metrics, is revenue. We had it increasing slightly, but due to, as Marcelo stated, the low growth of the industry, we have it growing at about 3% from 2025 to 2027, but it's still up from our pandemic years, as our actual for 2022 is 0.9. Another thing that I wanted to hit on is EBITDA. We had this at a margin of about 25% moving forward. This is due to, as Marcelo said, the reduction in resin costs, as well as a reduction in petrochemical costs, so we can see those margins grow slightly. Everything else is going to remain relatively similar due to the operations of the business not changing.
Yeah, so I'll take you all through a deeper dive within our publicly traded comparables. So here we chose 3 very similar companies, and we really focus on more of the aspect of how Larry's Laminate is run and how their business is ran. So each of these 3 companies display 3 different segments that Larry Laminate specializes in. And just as a disclaimer, this industry is very differentiated in terms of the products they deliver, and also they differentiate on the quality of the products as well as they give. So starting off with Armstrong World Industries, we thought this is a very comparable company due to how they operate their business and how they generate revenues. Although they have a very rather large EV to EBITDA multiple of 13.7 compared to Larry's Laminate, which is 8.8. We thought it was more aligned with how the products are delivered. And with the other 2 companies, Fortune Brands and PGT Innovations, they're more closely related to the specialty products that Larry Laminate delivers. So with Fortune Brands, it is their cabinetry unit that they specialize in, and it comes in at an 8.6 multiple. And then also with PGT Innovations, also with their specialty finishes that they provide with their products, it comes in at a 7.4 multiple.
Do you have any commentary on, those seem to be lower multiples, but obviously those businesses are massive compared to ours?
Yeah, so really at the end of the day, what we came up with was that each segment or each company displays a segment of Larry Laminate's process. So whether that be how they manufacture their goods, that's with Armstrong Industries, Fortune Brands, and PGT Innovations, more focus on their specialty products. And then that kind of relays over to how Larry's Laminate's sector of specialty products works.
Got it. So are you saying basically that your view is that the individual segments that best comp to our business probably trade a little higher than the conglomerate that PGT and Fortune and Armstrong are?
Correct.
It's also important to mention that the comparables that we looked at were relatively on kind of opposite ends of the spectrum. You've had a lot of low EV to EBITDAs and then a lot of high EV to EBITDAs. The 2 high ones, we obviously used Armstrong, which was one of the highest, and that was just based on comparison of the actual operations of the business. But the other one was important to mention. I think their ticker was DOOR, but they were trading, or their EV to EBITDA multiples were around 10 times. The only problem with that company is they were declining, had negative revenue growth and negative EBITDA going into future years. So we figured, dropping down as far as EV to EBITDA would be best in terms of keeping solid businesses that, can see growth like Larry's.
Maybe I missed this in the case as I was stuck on a flight last night. Where did you sell, if you don't mind sharing, depending on confidentiality, what did you sell our competitor for?
Yeah, we sold our competitor for 97. So we sold airtime to Lennox for about 97 million.
What was the multiple?
The multiple was about 6 times. So we think we can get you guys a little bit higher at about 8.8. They had some issues as far as their operations, and their EBITDA margins were not nearly as high as your guys's. So we definitely feel like we can push that when taking the buyers, if we decide to go down that route, or specifically, here within as far as management goes.
Next, for the valuation, we did the precedent transactions. And for this, we chose 6 transactions, which were highlighted out of the 20 up there And the 6 that we chose were chosen based on similar EBITDA margins as well as EV to EBITDA multiples. So Larry's was around 8%, so you'll see that these companies range from about 9 to 10%. And then with these 6 transactions chosen, we were able to pick like a low range and a high range. So we came to an enterprise value of about 106 million to 121 million.
Out of curiosity, why did you not pick the one that's 24 million in EBITDA that's closest in size to us?
Yes, we didn't choose that one based off their margins. Their margins were not relatively close to ours, so we figured it'd be easy to go with bigger players. We also figured, with transaction comps, private equity firms or whoever's the buyer is most likely going to pay a premium, so we wanted to factor that into our decision as well. And then moving over to our LBO, we did not think that this was necessary to put on the valuation football field. In conversations with obviously our group, but the debt to equity structure that we chose is about 60-40 debt to equity split with an EBITDA growth of about 6.5%. These are some of the assumptions we made. That EBITDA growth is on track with what Larry's is historically, and this would project a return of about 25.2%, which is relative to what the private equity company is looking for. I think they said they were looking for anywhere from 20 to 25% return on their investment. So this is, speaks to that, like for an MOIC of 3.1 times and a total gain of $81.9 million. It's also important to mention the purchase price fell around $99 or $99 million as far as our valuation.
Thanks, Nick. I appreciate it. So just something just to go over is the pros and cons of the private equity buyout and the management buyout. So the first few pros of the private equity buyout, we'll start with that, is since you guys are based in Chicago, they're also based in Chicago, so it's relatively close and can work much easier than for a company that was based farther out. Higher overall purchase price they'll give you compared to the management buyout. And then we've worked with StepStone before, and there's been times where the current CEO and CFOs have transferred over into the new company, so that's something we could definitely talk about with them, and I think they'd be open to it. And lastly, familiarity. Private equities, they tend to purchase companies of rather large amounts, so they've dealt this before, and they know how to operate and run a new company. So the cons of this private equity buyout is that it's a relatively slow process. I know you guys wanted a faster process, so that's one con. And then I know, Larry, you want to enjoy retirement, get out with the kids and the family, but you must stay 1 to 2 years. That's something on their clause that they're pretty fixed on, just because they can learn the business more and you're the best at that. And then it's lower multiple than our comparables, and lastly, it's a third party. It's on in-house sale. So management buyout, kind of pros and cons. They kind of relate to each other, but it's a faster process. Larry can transition out of the business right away. You have a relationship with the buyer since you do already work with them and know them very well. And then lastly, you get an interest in payout, which we'll discuss in the next slide or the next couple slides. The cons of it: lack of business ownership. Private equity is very familiar with that. It's a lower overall purchase price, and there's also a possible lack of funding. I know we discussed that the bank would possibly give it. It looks like it's going to be all squared away, but it's always just in management buyouts. It does tend to struggle with that. And lastly, less cash up front as well. Thank you. And then, so with that in mind, our offer is a management buyout. So even though it is a lower purchase price, it does allow Larry to exit in a timely manner. The transaction will be completed faster, so that expedited process you guys were looking for. And the ownership's well known, trust them already. It's in-house. And then lastly, it's also possible restructuring the deal, which we can discuss on the next slide.
So looking at the deal structure, we have obviously a presented deal based on your management team as to what you guys can do as far as enterprise value. So we're looking at 30% of your shares, which are going to roll back using our models and the enterprise value that we calculated. You're looking at an average of about $30 million for that portion. Their own capital, you guys are obviously footing the bill for about $5 million. The raised capital that you guys came up with from family is about $20 million. The bank loan was $20 million as well, and then the note and the interest was about $5 million and $1.7 million respectively. This gets us to an enterprise value of about $81.7 million, which is again on the lower range of where we were looking at, from 90 to 95 is what we think the company's worth. And what the private equity company is theoretically offering from the 7 to 8 times multiple. Some adjustments that we think could possibly be made to get up to that same enterprise value that the private equity firm is showing is keeping the shares, the own capital, raised capital, and bank loan similar, but possibly raising that note to 10 million if that is possible, and that would be an increased interest as well. We also thought it'd be important to possibly leave Larry on, leave you, Larry, on somehow for 5 to 10% equity, which would then give us opportunities for some type of earnout if an EBITDA goal is reached, hitting a certain number of cash flow that can be then transferred back to Larry in his 1 to 2 years as he's converting to retirement but still staying on as maybe a board member of something of that nature. And it also is important to mention that John and Sheila said that they plan to double the business in about 5 to 7 years. So having that 5 to 10% caveat and not selling the entire business would give him some room to benefit on the upside if he stays on that 1 to 2 years and possibly can reap the rewards of that growth.
And you could still, enjoy retirement as well, just be on the board and, just make a few key decisions, also just kind of teach them how to learn the business.
Are there any risks to the MBO that you're proposing?
Yeah, I would say that there are a few risks. Obviously, there's a conflict of interest, and obviously a lower enterprise value. I wouldn't say there's necessarily...
Who has the conflict?
The conflict is obviously it's within the company. So, I mean, as long as, Larry feels, as you, Larry, feel that Sheila and John are the best successors of the business, we feel like this is probably the best option. As far as riskiness, I wouldn't think that there's a ton on that end because you're making the buyout from in-house.
Where's the source of, maybe I mean that's it, where's the source of the 30% of shares coming from? I know that's John and Sheila's take at 27 to 33 million.
So we're using our enterprise value that we calculated for your company of about 90 million in enterprise value. So around 30% of that would be anywhere from 27.
Right, but so they own shares, right? They don't technically own.
Yes, we're just saying, so technically the money would not, it's money that would go back to them anyways. So if we sold to a private equity company, let's say, obviously they're going to get 30% of the proceeds as far as the enterprise value because they own stake in the company. We rolled that in to get to basically a level playing field of 100% valuation of the company as far as so we can compare this deal to the private equity deal.
So,
Yeah,
you're, I think is it possible that you're missing, on the adjusted deal, you've got 30% of the shares, you equate that to an equity value.
Yes.
Where is the existing debt as it relates to your enterprise value? Meaning, don't I have $22 million on the balance sheet?
Yes.
So what happens to that?
That's probably going to be paid off by management. So I guess you could say that there are some caveats as far as working capital and things of that nature, that where the debt goes, because this is going to be assumed, the debt's going to be assumed by John and Sheila. Okay.
And you mentioned that it would be a faster or quicker process if we do the management buyout.
Mm-hmm.
Can you just compare and contrast like an auction versus the management buyout? What is that time saving?
Yeah, so we would say probably some sort of an auction would take anywhere from, maybe 3 months relatively. We're looking at when you're selling to a private equity company based on letters of intent, NDAs, things that need to get signed, due diligence, and then as far as possibly not even having the deal go through, we're looking at anywhere from 6 to 9 months.
For an auction process?
No, for PE buyout.
And how much for the MBO?
It would be probably 3 months.
Well, that's on the maximum side,
Yeah,
I'd say as well.
it could be a lot less depending on, basically John and Sheila, you guys know the business very well and you know what you're purchasing. So there's a lot less due diligence that has to go into, and there's also going to be a lot more turnover as far as converting the new company to the private equity company, transferring over payroll, transferring over benefits, things like that, as far as things that have to transfer between ownership.
And would your fee structure be different then under those two scenarios? Okay.
Yeah, somebody could get those to you if you were interested in hearing that out as well.
Well, I'm curious, in the management buyout scenario, we've got these two managers who want to buy this. Larry wants to sell. What is your role?
We're provincial intermediary essentially. So since we even though they do know each other well and all that, there's a big process you have to go through.
Like what?
There's legal documents, which we have a law team we can consult with, and then there's also just even though they have expressed interest with getting financing from a bank, we could also be a lead on that as well. So that's something we could also do, and this is something that it's just a lot easier to facilitate when you have a bank, facilitating that deal.
So do I pay you or do they pay you? How would that work?
Yeah, it would probably be, they would be paying us for the service, so it wouldn't be necessarily Larry, you would not, or, no, Larry, you would be paying because you were the one selling the company.
So-
One more minute for questions.
I got one question here. So in your valuation, you came up with 111 million, but this proposed, what you're proposing we go with here is at 91 million. It feels like we're leaving $20 million on the table. So from your perspective, the upside of going and talking to other buyers isn't worth it, and just taking what's on the table?
It could be worth it. It could be something that we could explore. We figured, obviously, in talks, you guys are a little further along in the process and already have 2 potential deals on the table. Yes, we could take it to other buyers and see if they could give a higher multiple. We went relatively with the lower multiple because we felt like our overall valuation was a little bit skewed as far as our transaction comps were kind of on the low and high end. They weren't really intermediate as far as EV to EBITDA. So when we used that multiple to value the company based on those multiples, it got us to a little higher, and that's why the average is higher than what is stated around the 90 to 95 range.
And that's also why we mentioned a possible restructuring deal for Larry. You could get that extra 10 million, or we're also saying can roll over equity. John, Sheila, if you are confident that you can double this business in 5 to 7 years, and everyone wins down the road too.
Thank you very much.
Awesome, thank you.
Thank you.
There you go.
Thank you.